Howdy there, folks. A couple of videos I want to react to that have come out here in the last couple hours here. So I want to react to this one, We Haven't Seen the Worst Yet by Josh Brown, and understand what he is saying here in this 4-minute clip. And then I want to watch this one. It's a 5-minute clip from Jeremy Siegel, who's basically saying we're in a mild recession right now. Now, before we get into that, I want to read you guys something, a text that I just received, essentially. And I thought this was pretty interesting. I received this text from a friend. It says, more than 90% of stocks in the S&P 500 declined today. It's the fifth time in the past 7 trading days. Since 1928. There have been 0 times this has ever happened. This is the most overwhelming display of selling in history. That is pretty interesting, and it just kind of shows you how vicious of a market we are in, and man, has it been a vicious market. So yeah, I hope you guys enjoy this. As always, let's get into this, and let me know your opinion on whatever is said in these videos and my opinion on it as well. Let's jump.
Schwab today tweets, U.S. consumers losing interest in spending money on several goods and services. Only topics where Google search activity hasn't declined are exercise equipment, telecom, and job interviews. Kroger today talks about big trade downs, airfares falling for the first time, customers talking about rising prices, housing prices are down, mortgage rates are soaring. What do you say?
If you're listening to the Fed, the question is which Fed, because what Powell is saying does not jibe with what the Atlanta Fed's GDP Now forecast says. That forecast says we are in recession, no growth in the second quarter. So we'll, by the time we get like actual clean data post all the revisions, it takes a while. But I've made this point on the show. I've been making it for a while. It doesn't matter if we're in a recession or a soft landing, because in the minds of the consumer, and the consumer is 70% of the economy, it already feels like a recession. It already feels like a recession. So it's almost like semantics at this point.
I went in the video I did earlier today. I went through like a million different slides. If you didn't get to watch that one, yeah, definitely check out that one. But one of the things I did show in that video was consumer confidence, and we are at the lowest point we have been for consumer confidence in the history of doing that poll, essentially, which just shows like how bad of a place we really are right now. Worse than the great financial crisis, worse than the Rona crash, worse than the 80s, 70s, other time periods of even high inflation. It's worse than it's ever been.
In a slowdown, it feels horrible. The people who can least afford to be in an environment like this are obviously the people at the lower end of the income scale. And while a strong labor market has helped, I want to show you some markets that I think are going to have a negative multiplier effect that we will be feeling for at least the next 2 quarters, almost regardless of what the Fed does at this point. They actually can't even help here. We just had mortgage rates surge to 5.78%. That is the largest 1-week increase since 1987. Yes, that 1987. Housing starts declined 14.5%.
For those of you who aren't brushed up on your history, 1987, we actually saw the craziest stock market. Like one day, the market fell like 22%. There was actually a lot of things that ended up getting put in the stock market essentially after 1987 to prevent from situations like that. So if you're wondering where all these things came from, like the limit downs and them causing a pause in the market if the market gets too freaked out and things like that, a lot of that came from the 87 crash. So that's why he's referencing that.
From April to May. That is an enormous decrease. Single family starts dropped 9% to an annual rate of only 1.05 million month over month. And why that's not great is really the only engine of the economy that we can rely on is the positive multiplier effect from new household formation. The demographics are on our side, but that's not working out if we're not going to build enough affordable homes, and we're not. And so now building permits fall another 7%. That's month over month. That's not versus last year. These are startling, almost overnight declines.
And that's going to get way worse in terms of the housing. I spoke about that a million times, but in terms of housing in new home starts and things like that, it's going to get so much worse over the next 6 to 12 months. It's not even funny.
In the layoffs that we've heard about from Compass and Redfin, and there will be more. And so you see the home building stocks. You see DHI, you see Lennar, NVR, you see Pulte. Mm-hmm. They're all down somewhere between 5 and 8% today. But they're tiny stocks. Those stocks don't matter at all to the calculation of the S&P 500. However, the product that they sell is enormously important. And when you lose that,
the product is enormously important for the economy. You should have finished that off there. It's enormous, and I went over this in a video recently, showing like how many different companies benefit from building a new house. Right? It's not just like that new house is magically built. The amount of jobs that are created from somebody building that new house, all the new furniture somebody gets for that new house, the floors, the counters. It's so many people and so many businesses. It's like, in my opinion, it's the best thing that ever happens to the U.S. economy is when the housing market's in a good place, because it's enormous. And so, yeah, the stocks don't matter that much for the market because they're smaller companies, in relative to, these $100 billion, $500 billion, $1 trillion companies, but they matter so much for the overall economy. And that's a great point Josh brings up there.
Aspect of consumer confidence and spending, when the home that they're in doesn't sell, and when applications to buy new homes declines, a lot of ancillary spending in our economy goes away with that. So you're probably going to have a bust, quite frankly, in durables. If you bought a new washing machine in 2021, you're not buying one in 2022, obviously. So I think that is really important, because we talk about this transition of the economy. Mm-hmm. We're going to go from items to services. Okay, that sounds great. The thing is, services are very small in the S&P 500 earnings. Durable goods and actual items that we buy are very large. It's just a relic of the way these indices were originally constructed. So if you understand that the few remaining areas where there's consumer enthusiasm, like travel, are really tiny for the earnings picture, then it's hard to say that having earnings up 8 or 9% this year is realistic. And what that
is very, very important. He just mentioned about travel. And travel is supposed to be, obviously having a great summer. From everything I heard, the airlines are busy, hotels are busy. It's a great airline summer, essentially, in travel summer. But look at the stock prices. Look at the stock prices. Almost all those stocks are basically back down to getting close or at basically the lows they were in 2020 now. Isn't that extraordinary, right? And so that's kind of some food for thought in this situation, that you got that sector supposedly doing good, but no one wants to own those stocks, because at the end of the day, if people feel like we're going into a recession, no one wants to own a Wynn Resorts. Nobody wants to own a CCL. No one wants to own a Delta Airlines, an American Airlines, a Hawaiian Airlines. Nobody wants to own those stocks, a Royal Caribbean, if you're going into potential recession, MGM or and whatnot, right? So it's very interesting.
Meaning is people coming out, cutting estimates, and you will see them start to say in 2 months and 3 months what I am saying now, which is that negative multiplier effects from high gasoline, from overconsumption over the last 2 years that doesn't need to be repeated,
right,
and from falling home values and home equity and stock market portfolios make it so that the idea of a soft landing really becomes laughable. And the longer this goes on for, the more laughable it is. So I'm holding out hope that it doesn't have to be 2008 or anything like that, but we've not seen the worst yet.
So I mean, him and I see pretty eye to eye on a lot of that there. Okay?
Let's ask famed
This one I actually haven't even watched yet. That one I had seen. This one I have not seen, so this should be interesting. We're in
Sir Jeremy Siegel. He joins us today from Philadelphia. Professor, it's good to see you. Welcome to Overtime.
Yeah, I agree with you, Scott. This week was brutal. Today was brutal. Let me tell you, we're in a recession. It's a mild recession. It's not an official recession by the NBER, certainly not yet. But this first half is negative GDP growth, and it's ending on a slide. And, just when the Fed is, the most aggressive because it waited far too long, it's interesting. I mean, the data that I found so interesting on Wednesday, more even than the 75 basis points FOMC was that retail sales data that we got in the morning. Wow, that was shockingly low, and momentum downward, and every single indicator we've gotten since then has really surprised pretty dramatically on the downside. So we're cooling off the economy. Let's just hope it's not too fast.
Yeah, so something important he touched on there is obviously the Fed having to raise into a weakening economy. He obviously said very confidently that we're in a recession. Like there was no guesswork there. He said that very confidently we are in a recession right now. His belief is. Now, something very, very important I want everybody to understand here is I think the Fed's going to pivot way faster than everybody's expecting. You know, I've heard some people say, like Ray Dalio said, he thinks the Fed's going to pivot in 2024 and start reversing rates. I heard some people saying, 5-6 years down the road, it's going to happen so much more quickly because what's going to essentially play out here? One, the economy is going to weaken considerably, and next thing you know, they're going to recognize, we're in a recession. Okay, then job losses will come. Inflation is coming down, don't matter what. And the reason being is oil prices are going to end up tanking. It's having its hot summer, but oil prices will come down. We've never seen it ever where into a recession, you get oil prices to stay at very, very elevated levels. Look at 2008, right? Oil prices were going sky high into that recession. And once we recognize we're in a recession, oil prices started to tank down, for instance. Obviously, look at the 2020 situation, but that was a little bit of a freak situation. Oil went negative. That's not going to happen. But oil price will come down. That's going to help inflation as well. On top of that, rents will actually start coming down, in my opinion, in 23. And the reason being is I went over this all very, very in depth, essentially, in the video I did earlier today. But you've had a massive amount of apartment complexes be built. Folks are going to start moving in with other folks between the inflation that's going on. Never mind if earnings start going down, job losses come. That would be a situation where folks would end up moving in with other people, right? That's just what happens in an economic decline. And so that's going to be a whole situation that plays out. Meanwhile, apartments are going to try to maybe raise rent, but they're not. People aren't going to pay it at the end of the day. And the apartment complexes are either going to be faced with a situation of massive vacancies and potentially not meeting cash flow to pay off their loans, or what do they have to do? Cut price. And then you get into this kind of vicious kind of price cutting situation where this apartment has to cut because this other apartment's actually filling up vacancies, and there's a limited pool of folks out there. So that's what ends up happening, okay? And so never mind, on top of that, housing prices are going to start coming down massively in the back half of this year and into 23, which is going to make folks that rent homes have to drop price as well. And I know a lot of people can't even consider that right now, but it's going to be what ends up playing out. It's just you do what you have to do. And let's say you're trying to rent your house and it's not renting. What do you end up doing? You're going to cut price. So all that's going to play out essentially. Now, as inflation comes down and the economy gets weaker and weaker and weaker and more job losses come and things like that, the Fed will turn. And the next thing you know, they'll go from raising rates to cutting rates. And it's going to play out way faster than I think a lot of folks anticipate here. It's just kind of a matter of time in that whole situation, okay?
Point to a significant issue that we need to discuss, and that is the idea of a Federal Reserve that waited too long and now is acting too much. And that seems to be where we are in this world, what has unsettled this market so dramatically, this very issue that because they waited so long, Professor, and they're doing what is deemed to be too much now, they're going to break something along the way.
Yeah, and remember I commented, 3 weeks ago that we already had stopped the growth of the money supply, which was the second largest monthly decline in 60 years. I was sort of startled. I said, something's going on here. We're going to get another money supply soon. It looks like they're stopping the economy right in the tracks. We don't want to go through the windshield here, slamming on the brakes. They had to do it what they had to do. We might be surprised instead of 50 to 75.
Just look at those stock prices there. Norwegian Cruise Line's 11.5%. Was that $10 or whatever? Royal Caribbean, down to 35, down 11%. Carnival's at $8. These stocks are priced basically around the same prices they were during Rona. Like, that's extraordinary to think about. And I'm talking about like the Rona lows. They're right around there now at this point in time. And these stocks are being priced like we're already in not just a mild recession. These stocks are being priced. This is very important, okay? These stocks are being priced like we are in a massive, colossal recession right now. That's the way those stocks are being valued. When you see these stocks at these sorts of prices, they're being priced like we're in a massive, colossal recession. Not a mild recession, a massive recession, okay? That's how you get a CCL at $8.
We might be surprised instead of 50 to 75 basis points in July, it might be 25. if this slowdown really continues. Now, we saw oil up a bit today, but we know so many of the other commodities have rolled over. And the economic momentum has really sharply turned negative. And
something that bothers me there is not with what Jeremy Siegel says there, but just this is like a notion. People think the Fed can magically save the day when it comes to inflation. No, they cannot. Sometimes you just got to think about these things from a common sense standpoint, right? Can the Fed, by the Fed raising rates, does that magically fix the fertilizer problem we have going on right now? No. Does the Fed raising rates magically fix, wheat prices and make magically there be more wheat? No, that doesn't fix that, okay? Does the Fed raising rates magically fix the Russia-Ukraine conflict? No, that doesn't fix that. None of that magically gets fixed. All these issues that are exacerbating, essentially, inflation to insane levels, a lot of that the Fed can't fix that. The Fed can help out cool down, or I shouldn't say cool down. The Fed's going to crash the housing market. Okay, the Fed can crash the housing market. The Fed can crash the stock market, but there's a lot of things that the Fed's not going to magically going to be able to save the day. Time just has to play out until fertilizer's in a better place, refine. Can the Fed, is the Fed, by them raising rates, is that going to magically make there be a bunch more oil refineries? No. Sometimes I think it's important that people just think about these things logically, because a lot of folks are under the assumption that the Fed can magically fix inflation. And that's not the way this works. They can help some parts of inflation, but they can't help the whole thing. And that's just factual, okay? Let's get into this.
I think that's certainly something that the Fed has to be concerned about going forward.
You can't have it. You can't have it both ways, though. You wanted them to do 100 basis points.
I wanted them to. Yes, and it's to capture the negative that we're serious, and I think they did that. We've seen a rise. I look at the TIPS yield because I think that's the most relevant discount rate for the stock market, and I've never seen a rise like this. It was less than -1 at the beginning of the year. It almost earlier this week hit +1. Now that's a 2 percentage point increase in the discount rate. That is mammoth in a period of less than 6 months. So you wonder, why are stocks down 20%, 25%? Put that in a discount formula, and you will see why that is happening. And that is really all on anticipation that the Fed has to step on the brakes, slow that money supply. It is happening. Let's hope, they can't go overboard. They got to be looking at this data. Being too late sometimes means that you may react too much. Not yet, but we're in the problem. Scott, let me...
I agree. I think the Fed's going to play it wrong, both sides here. One point I want to make, this is a very important point here. I want to make sure this is set out there. And this causes a lot of frustration with folks, right? Here the Fed is raising interest rates. But let me ask you a question. Why haven't the banks started to skyrocket their savings rates that you get from savings accounts and things like that? We haven't seen that play out yet, right? Isn't that interesting? Somebody's keeping some profit there. Fed's doing all this movement of rates, and yet, most people, I see it all the time. Like, people are like, why is my savings account not moving? Like, where's all this extra money? Like, shouldn't I be getting a much higher rate on savings accounts? That's just interesting, isn't it? Isn't it interesting? So, eventually maybe that turns around, but right now it's kind of funny, right? Who's keeping that profit there?
Something on the good side. On the good side, despite the fact that the first half of this year, GDP is down, earnings are up 5% over the previous 6 months of last year. So even with a negative GDP growth, we actually managed positive earnings growth. So that's actually saying something. And also think about the fact that we're going to be in earnings week, and we're going to be at the end of the quarter in 2 weeks. Then 1 week after that is earnings season. I haven't heard a lot of warnings. I mean, we heard targets. Not yet. This is the time Now, maybe the fall off, we're going to start getting them. But by and large, even with this slowdown, earnings are coming in fairly good. A definition of a recession technically is 2 consecutive quarters of GDP. Now, we're not going to get 2 consecutive. And by the way, the only reason we're having positive GDP, and I think we will get slightly positive in this quarter, is really what we saw in April and early May. End of May and June so far is a negative GDP by all indicators.
Okay, so Jeremy Siegel brings out actually a really good point there, and I haven't even thought about that. That's actually a really good point. We haven't seen massive amounts of companies come out and pre-announce numbers, right? Usually if a company has disastrous numbers to present, they usually come out and pre-announce. We haven't seen that. We've seen it from a couple companies, but not that many, right? Snapchat, Target. But it's not like there's this huge group of companies that are all like, oh my gosh, we're not even going to get close to guidance and things like that. So that's good, right? On the flip side, we haven't seen any companies pre-announce that they got good numbers either, right? So, you can look at that kind of both ways. But in my opinion, a lot of these companies are probably going to either slightly miss earnings, or potentially majorly miss earnings. They just aren't pre-announcing because it's not that devastating of a number that they feel like they don't need to pre-announce. And then you'll have a few companies that kind of come in line, right? It really depends upon the business model, right? And Adobe reported earnings today, and the numbers were pretty respectful. Stock still went down after hours because their guidance wasn't quite up to par, but that wasn't really because their customers have dropped off. But it's a very, very special business model. That's a recurring revenue stream that's not super expensive, so they're in a very special spot. But what about the home builders? What about a lot of these retailers? What about some of the restaurant names that have been destroyed by labor, that have been destroyed by food costs, and now potentially could start seeing their restaurants slow down? What about that sector? Travel is hot right now, but what about forward bookings or bookings into the fall time and into the winter time still looking good, right? So there's so many different moving dynamics here that we still got to kind of see play out. But I thought he brought up a good point there at the end. So let me know your guys' opinion in that comment section. I'd love to hear from you guys as always. As far as me, you guys know me. I buy. And NASDAQ is down 34% as of today. I don't know if that's the bottom or we're going down 44, 54. All I know is there's a lot of stocks that I think are smoking deals, and I'm buying those stocks, and I'm going to continue to. We got a 6 to 18 month window here where I'm just looking to add. And as we come out of this crash, whether that be in a month from now, 3 months, 6 months, 9 months, 12 months, whatever, I'll continue to buy as we come out of that. And I like to buy when stocks are heavily discounted. Much love as always, guys. Check out the description area. Got all types of fun stuff down there, and have a great day.